The information provided in this video is for general informational and educational purposes only. It is not intended as professional financial or investment advice. Always seek the advice of a qualified financial advisor with any questions you may have regarding your personal financial situation or investment decisions. The creator is not liable for any errors or omissions, or for any losses or damages you may incur as a result of relying on this content. Past performance is not an indicator of future results. Do your own research.
We begin with the most pressing developments surrounding Nvidia and their standing in the semiconductor arena. The headline story for late 2025 and early 2026 remains the rollout of the Blackwell architecture. After facing initial design-related delays in mid-2024, Nvidia has successfully ramped up high-volume production. The GB200 NVL72, a liquid-cooled rack system containing 72 Blackwell GPUs, has effectively become the new unit of compute for major hyperscalers like Microsoft and Meta. This move shifts Nvidia from selling individual chips to selling entire data centers, significantly increasing their revenue per customer. In the broader market, Nvidia has cemented its sovereign AI initiative. This strategy involves partnering directly with nations, such as Japan, Canada, and France, to build domestic supercomputers, diversifying revenue away from just US tech giants. On the corporate front, Nvidia recently acquired SkedMD, the developer of the Slurm workload management software. This is a critical, under-the-radar move that strengthens the software ecosystem around their hardware, making it even harder for customers to switch to competitors. Speaking of competitors, the landscape is shifting. AMD has emerged as a credible second source for AI accelerators. Their MI325X and upcoming MI350 series have captured approximately 8% of the market, appealing to customers who fear vendor lock-in with Nvidia. While AMD is not yet dethroning the king, they are winning meaningfully in inference workloads where cost is a higher priority than raw power. Meanwhile, Intel remains in a challenging position. Their Gaudi 3 accelerator is being marketed aggressively as a cost-effective alternative for mid-market enterprises that don't need Blackwell's extreme performance. However, Intel's financial struggles and restructuring have limited their ability to outspend Nvidia on R&D, leaving them fighting for a distant third place in the accelerator market. Nvidia's news cycle is dominated by execution and expansion, while its rivals are defined by their attempts to catch up. Moving into the numbers, we need to look at Nvidia's financial health not just in isolation, but in direct contrast to its peers. As of early 2026, Nvidia is trading at a price-to-earnings (PE) ratio of approximately 46.4x. On the surface, this sounds expensive compared to the broader S&P 500. However, when you compare it to AMD, which is trading at a trailing PE of over 100x, due to lower recent earnings, and a forward PE closer to 50x, Nvidia appears more reasonably priced relative to its realized profits. Intel, conversely, trades at a distorted multiple due to depressed earnings, often showing a forward PE in the low 20s, reflecting the market's skepticism about their growth. A critical metric here is the PEG ratio, price/earnings to growth, which contextualizes the premium you pay. Nvidia boasts a PEG of roughly 0.72. In the world of investing, a PEG under 1.0 is considered cheap for a growth stock. This suggests that despite the high stock price, the market may still be underestimating the speed of Nvidia's earnings growth. Compare this to AMD, which sits at a PEG of around 1.3, indicating investors are paying a steeper premium for AMD's future growth than for Nvidia's. Nvidia's price-to-book (PB) ratio is an eye-watering 38x, vastly higher than Intel's 1.7x or AMD's 5.8x. This reflects that Nvidia is a capital-light designer. Its value is in intellectual property, not factories. Efficiency is where Nvidia truly shines. Their return on equity, ROE, is nearly 30%, significantly outperforming AMD, which hovers in the single digits, around 4 to 7%, and Intel, which has struggled to stay positive. Finally, the debt-to-equity, D/E, ratio for Nvidia is a pristine 0.09. This is a fortress balance sheet. In comparison, Intel has a D/E of roughly 0.44, burdened by the heavy capital costs of building foundries. Nvidia has the financial flexibility to weather storms that would cripple its rivals. Valuing Nvidia requires two different lenses, the discounted cash flow (DCF) model and the dividend discount model (DDM). The results from these two models paint vastly different pictures, and understanding why is key to understanding the stock. Let's start with the dividend discount model, DDM. This model values a company based on the cash it pays back to shareholders. Nvidia pays a minuscule dividend, just 1 cent per share quarterly. If you run a standard DDM with a 10% discount rate and even a generous dividend growth rate, the model would value Nvidia stock at less than $5 per share. Why? Because Nvidia is not an income stock, it is a total return vehicle. It reinvests almost every dollar of profit into R&D rather than distributing it. Therefore, for an investor, DDM is effectively useless for valuing Nvidia and should be ignored in favor of growth metrics. The discounted cash flow (DCF) model is far more relevant. This essentially tries to calculate the present value of all the future cash Nvidia will generate. Here, analysts are split. The bearish DCF, if you assume Nvidia's growth slows down to 15% annually over the next 5 years as competition heats up and the AI boom cools, a conservative DCF suggests an intrinsic value of around $62 to $90 per share. This implies the stock is currently trading at a massive premium, pricing in a future that is nearly flawless. The bullish DCF, however, if you input the consensus view, that data center revenue will grow at 30% plus for the next 3 years due to the Blackwell cycle and software margins, the fair value jumps to $230 to $270 per share. The market is currently pricing Nvidia somewhere in the middle of these scenarios. It is betting that Nvidia will not just be a hardware chip seller, but a platform company with recurring software revenue, like Apple, which warrants a higher valuation multiple than a standard hardware maker. Beyond the spreadsheets, we must evaluate the moat, the qualitative factors that protect Nvidia's castle. The strongest wall in this fortress is CUDA. This is Nvidia's proprietary software platform that developers have used for nearly 2 decades. While AMD has developed its ROCm open-source alternative, and Intel pushes One API, neither has the millions of lines of optimized code and developer loyalty that CUDA possesses. For a company to switch from Nvidia to AMD, they don't just need to swap a chip, they often must rewrite their entire software stack. This switching cost is Nvidia's greatest asset. Another qualitative factor is Nvidia's ecosystem approach. They don't just sell the GPU, they sell the networking, via their Mellanox acquisition, and the CPU, Grace Hopper. This allows them to control the speed of the entire data center, not just the calculation. Competitors like AMD and Intel are trying to replicate this, but they are often piecing together solutions from different vendors, which can lead to integration headaches for customers. However, a major qualitative risk is supply chain concentration. Nvidia relies almost entirely on TSMC, Taiwan Semiconductor, to manufacture its chips. While AMD and Apple rely on TSMC too, Nvidia's entire existence is tied to the geopolitical stability of Taiwan. Intel, for all its faults, has its own factories, fabs, in the US and Europe. If a geopolitical crisis occurs in East Asia, Intel's qualitative value would skyrocket overnight, while Nvidia's supply could be cut to zero. Finally, we must consider management. CEO Jensen Huang is widely regarded as a visionary, often compared to Steve Jobs for his ability to see market shifts years in advance. In contrast, Intel has churned through CEOs, and AMD's Lisa Su, while brilliant, is playing a game of catch-up against a leader who is setting the rules of the game. Investors often obsess over Nvidia's data center chips, but to understand the company's future, you have to look at its smaller bets. These are the seeds Jensen Huang is planting for the next decade of growth. First is healthcare and BioNEMO. Nvidia is aggressively entering the drug discovery space. They view biology as an information processing problem. By using AI to simulate how proteins fold and how drugs interact with the body, Nvidia aims to cut the time to discover new medicines from years to months. They have invested in over 1,800 healthcare startups through their Inception program. If they become the standard platform for digital biology, this could eventually rival their data center revenue. Second is robotics and Project GR00T. This is a foundational model for humanoid robots. Nvidia isn't building the robot bodies, they are building the brains, the AI models, and the GIM, the Isaac Lab simulation, where robots learn to walk and work before they ever enter the real world. Partnerships with companies like Agility Robotics and Boston Dynamics place Nvidia at the center of the industrial automation revolution. Third is automotive. While currently a smaller slice of the pie, the Nvidia Drive platform is a full-stack solution for autonomous vehicles. As cars become software-defined, Nvidia is positioning itself to be the operating system of the automotive industry. Lastly, there is the venture capital arm, NVentures. They are investing in companies that use Nvidia chips, effectively creating their own future customers. By funding startups in sovereign AI, climate simulation, and aerospace, they ensure that the demand for GPU compute continues to grow, regardless of which specific industry is booming. These bets are call options on the future. Most may fail, but one massive success could sustain the company's growth when the current AI hardware boom eventually slows. The bull case: the bulls argue that we are in the first inning of the AI revolution. They believe the market is underestimating the shift from training AI models, which are what we do now, to inference, using the models, which will require exponentially more computing power. Bulls point to the PEG ratio of 0.72, arguing that Nvidia is undervalued relative to its growth. They see the sovereign AI trend, nations building their own AI clouds, as a massive, price-insensitive source of new demand that will offset any slowing from corporate buyers. Furthermore, they believe Nvidia's software revenue, Nvidia AI Enterprise, will explode, pushing gross margins even higher and locking customers in for decades. In this view, Nvidia has become the most valuable company in history, the utility provider for the digital age. The bear case: the bears argue that Nvidia is pricing in perfection. They draw parallels to Cisco in the year 2000, a company that provided the plumbing for the internet and saw its stock crash 80% when customers realized they had overordered. Bears warn of inventory digestion. Big tech companies like Meta and Google are buying billions in chips now, but eventually, they will need to pause to absorb that capacity. Bears also highlight the China risk: further export restrictions could cut off a vital market permanently. Finally, they point to competition. Amazon, Google, and Microsoft are all designing their own custom internal chips to reduce reliance on Nvidia. If these custom chips become good enough, Nvidia loses its biggest customers. Summary: Nvidia is a company operating at peak performance with financials that are the envy of the industry. However, its valuation demands that this perfection continues uninterrupted. For the investor, the decision comes down to whether you believe AI is a continuous, decades-long industrial revolution, bull, or a massive, cyclical capital expenditure boom that is due for a pause, bear.